2023, 5,200. 2024, 7,500. 2025, 9,800. You must be wondering why I'm rattling these numbers. Well, these are the numbers of the ultra HNIs and Centi-millionaires of the world that have recently moved to Dubai. And in 2026, this number is expected to double. Over 65% of the global HNIs aspire Dubai to be their second home. Since Dubai is the destination, these people have come with the intention of building a real estate portfolio for long-term financial freedom. Recently, I met such investors who had purchased multiple properties. However, when I analyzed their holdings closely, what I discovered was not a portfolio at all. What they were thinking to be a portfolio was unfortunately a bunch of properties spread across different locations and price points, with no real structure or strategy behind them. This exposes them to unnecessary risk and defeats the purpose of their investments. Hi, I'm Iram from Xperience Realty, and with nearly a decade of experience working with family offices, sovereign wealth funds and private equity firms across global real estate, I've put this video together to help you think the way institutional investors do, bringing clarity, structure and direction to your Dubai real estate portfolio. When I started having one-on-one conversations with property investors here in Dubai, I realized something surprising. Even the very experienced and successful investors were quietly struggling with the same questions. They own multiple properties, but they're not sure which ones to keep, which ones to sell, or what role each property actually plays in their portfolio. Many don't really know whether their investments were truly diversified or just spread across locations. They weren't sure how balanced their risks and returns actually were, or whether the assets they bought years ago still make sense in today's market. If any of this sounds familiar, don't skip this video and watch it until the end, because the clarity you're looking for is right here. These aren't small doubts. This is the difference between simply owning properties and actually building wealth. Most investors assume they have a portfolio, but because we work closely with institutional buyers, we understand how structured and resilient portfolios are built and managed. So let's understand the steps of building a portfolio. The first step is understanding what a portfolio truly means. A real estate portfolio is a structured mix of just three types of assets: income, growth, and defensive asset. A well-structured portfolio is built across all three. The proportion allocated to each depends on your risk appetite, cash flow requirements, lifestyle preferences, and the nature of your business. In many cases, age and life stage also play an important role in shaping the right balance. Now let's understand what these assets mean and what role do they play in your portfolio. So growth assets are typically undervalued today but have a strong potential for capital appreciation. Examples would be Emaar Beachfront, Dubai Maritime City, the Oasis by Emaar, Dubai Hills Estate, and Dubai Islands. It's largely a matter of time before these locations appreciate, driven by infrastructure growth, and even begin delivering higher rentals as well. These are the future safe havens of Dubai's real estate market. Growth assets are usually bought at a lower entry value. They don't make noise every day, but over time, they build the real strength of your portfolio. This is where compounding happens, benefiting from timing, infrastructure, price discovery, while quietly doing the heavy lifting over a full market cycle. Income assets are the assets that generate regular cash flows to help pay for your ongoing lifestyle and expenses, at the same time bringing discipline to your portfolio. In Dubai, these are often professionally managed or hospitality-led properties. With income assets, the primary focus is rental returned, and as you build a portfolio over time, many growth assets naturally evolve into income assets. So the question is, do you buy income assets directly? Well, the answer depends on your age and your business cash flow. If you have strong capital and steady income, you can structure the portfolio and include income assets from day one. although they typically would come at a premium. If you're at the onset of building a property portfolio, starting with growth assets often makes more sense. Over time, these assets transition into income-generating properties, often delivering higher overall returns. Now, the third one is the defensive asset. These assets have transformed themselves into a value-holding asset. They don't see much volatility even in the most difficult times, like the assets in downtown, Dubai Hills Estate, ranches, Emirates Hills, villas and townhouses in District 1, where the prices generally remain absolutely stable and don't keep changing as the market changes. They are the AAA rated bonds and treasures that will keep the value intact, and it takes a lot of vision, time, and development to convert an entire area into a defensive asset. They are the reserves. Defensive assets are not flashy, but they protect your capital, preserve liquidity, and give you the freedom not to sell when the market slows down. These are the assets banks trust and end users return to first. So now, as we've understood that there are only 3 roles that an asset can play, this is the stage your financial advisor would conduct a detailed analysis and recommend how many assets are required and in what ratios. Following that, a property consultant with a strong understanding of finance identifies the right assets and helps you build the portfolio progressively over time. Clients always come asking, what's the hottest project in the market? Well, this is a risky approach. Institutional investors don't ask what's trending. They ask, what role does the asset play within the portfolio? Because if you can't explain an asset's purpose in one clear line, it does not belong in your portfolio. And that is the key difference between collecting properties and truly running a portfolio. Now, since we've understood the first step, which is what a portfolio actually means and the role of the asset classes, the second step in portfolio building is understanding your business, cash flow, risk appetite, the assets that you're currently holding and analyzing them, and also the age demographic that you are in. Based on these, the decision can be taken for what ratio the assets must be put into your portfolio. If you are someone who has already built generational wealth but are no longer into money making and are looking to enjoy a quiet and leisurely life, at the same time experience the fruits of your labor but in a smart and savvy fashion, then you could consider having a higher ratio of the income and defensive assets, as the income assets would assist you with the daily runnings and operations of your relaxed lifestyle, and the defensive assets would be there when the market quietens down. Now, if you are in the younger demography who enjoys the finer things in life with a large vision for the future and want to build your generational wealth, your risk appetite would be more sizable than someone who has already built his legacy. In this case, you would be needing a much higher ratio of the growth and income assets as compared to the defensive assets. To simplify it, the higher the age bracket, the more income and defensive assets are needed. And if you are younger and doing well for yourself, you could consider holding a slightly greater ratio of the growth assets. When you have understood your nature of your business and lifestyle, the third part consists of buying in the right ratio. Once your financial advisor has given you the guidance of which asset classes need to be bought and in what ratio, that is when your property consultant comes into the picture. They then prepare a list of the best performing assets in the respective classes. Once done, it has to be diversified after the critical evaluation of certain criteria. Hence, it is very important to choose a property consultant that understands diversification, as it cannot be random. Now that you've selected a consultant that understands diversification, they will then give you a curated catalogue of the high-performing inventories in waterfront as well as non-waterfront, whilst maintaining a good balance between the typologies of the villas, townhouses and apartments as well. They will also be knowledgeable enough to evaluate the requirement of every asset class and their diversification after streaming them through specific parameters such as payment plans, segments, supply, ticket size, and the uniqueness of the communities and developers. It may sound simple, but it's quite the opposite. Hence, it's imperative to choose your property consultant wisely. Now comes the fourth part, where you will look into building and managing your portfolio, as buying well is only half the job done. Since you've chosen different ratios, assets and properties, now takes place the building of the portfolio with the acquisition of these assets. The management part starts thereafter. We must remember that throughout the cycle of the assets, they will keep evolving. Over a period of time, a growth asset slowly morphs into an income asset and then eventually into a defensive asset. The end goal of every asset is to transform into a defensive income asset. For this goal to be achieved, the property manager will not only have to keep an eye, but also submit a detailed report annually or biannually, critically evaluating the mutation of your assets to warrant your portfolio's diversification. It is crucial to exit from the assets that have excelled and passed on from the growth stage so that you can enter into new opportunities. Saying that, it is important to retain certain assets based on the diversification criteria. For instance, waterfront is limited, so you are aware that the asset you've invested into is scarce. However, we must assess the mutation stage of the asset class and then decide whether we need to retain it or exit from it. We do this so we may enter into similar opportunities in the same segment that would multiply your growth instead of keeping your investment stagnated. To elaborate with an example, at its conceptual stage, Emaar Beachfront was bought by its investors for 1,400 to 1,500 per square foot. It has given immense growth, no doubt, and has now morphed into a defensive asset. Now, a smart investor at this stage would liquidate some of its ratio and then invest it into a similar potential segment like Rashid Yachts and Marina, Maritime City, and Dubai Islands. But at the same time, we must keep in mind we need to find similar segments so that the growth of the asset does not derail the diversification ratios. If we talk about early investments in apartments in Dubai Hills Estate and downtown, they have long crossed their growth stage, as these have now morphed into the defensive income assets. Hence, diluting one's proportion here and looking into Dubai Creek Harbour, Emaar South and Expo City would be a good decision. The same pattern is observed in the villa segment. Those who bought Dubai Hills Estate at its early stage can now diversify into Oasis, Dubai Islands, the Heights by Emaar and even Palm Jebel Ali if their vision is longer. We are now close to completing the entire circle of portfolio building. However, we must always strategize a smart exit. An exit strategy should be such that entering or investing into a growth asset should not come at the cost of diversification. Even if you are departing from your asset, you should make an informed decision and not make the mistake of exiting unique or scarce projects. There are some projects that are unique either by their scale, typology, or location and cannot be replicated. These projects hold value to the very end and are considered as the crown jewels of your portfolio. To name a few, we have the Royal Atlantis, the higher number villas at the Palm, some villas in Jumeirah, prime golf-facing villas in Emirates Hills, some properties in DIFC, and LEED certified commercial spaces. These assets are growth, income, and defensive, all three in one. So selling such assets could be the mistake of a lifetime. If this cycle of building and managing a portfolio is followed, you are on the right track of portfolio management. Always aim to build your portfolio like a legacy bond. Let me now give you a brief idea of what the non-negotiables are for a healthy portfolio and what we need to avoid at all costs. To give your property a AAA credibility, we need to fulfill certain criteria such as ensuring that your developer has a good history and track record for the delivery and product, doing a detailed analysis of the segment, typology, community and supply, as well as evaluating the payment plan, ticket size and quality of the buyer. Satisfying these makes our collection of properties a AAA grade portfolio. Once the non-negotiables are established, the next discussion is about what to consciously avoid. Many investors are lured in by attractive payment plans and brand-driven hype, often with the expectation of a quick sale. This is a segment we strongly advise our clients to stay away from. The risk lies in the buyer profile in these projects. While a project may appear sold out at launch, it is frequently followed by oversupply in the secondary market. When a large number of similar investors attempt to exit at the same time, your asset's liquidity dries up. So not only is the growth in this type of product limited, the exit becomes difficult too. In other words, even if the product sells out quickly, it does not necessarily translate into sustainable demand or long-term value. One should never compromise with the fundamentals of real estate investment. Real estate is not for flipping. People with higher cash flows are drawn in with the concepts of furnish and sell. And I have seen one too many clients getting caught in this web. It sounds too easy, but the execution of this requires the highest expertise and precision. I hope I haven't disappointed you by not discussing any hot projects or giving any property suggestions, as the geek inside me could not gatekeep this information anymore. If you have any questions or concerns, or feel it's time to diversify smarter, let's have a conversation.